Today I'll provide a sector preview on the industrials supergroup. In terms of the sectors and stocks that are included, it is quite broad, ranging from packaging and logistics, construction and engineering, to chemicals, agriculture, and a range of others as well. Just one thing to note, the chemicals and ag stocks, most of them do have a September year end, so they won't be reporting their results this month. But we are expecting trading updates from the likes of United Malts Group, Grain Corp, and also Incitec Pivot. Okay, so what are the key things to look out for during reporting season? So firstly, obviously the global macroeconomic environment. Obviously commentary on anything related to the global macroeconomic environment will be very important, especially in the key regions of North America, Europe, and Asia. And we should get a good idea of how the various regions are going through results from global companies such as Amcor, which reported yesterday, Brambles, and also Reliance. And on that Amcor result yesterday, just to quickly, the result was largely in line, but the outlook was a little bit softer than expected. I think the key takeaway from the result was that volumes did weaken towards the back end of that first half. And it does look like, and that was on the back of lower consumer demand and also some customer destocking. So it does look like the higher interest rates and also that the cost of living pressures are starting to impact global consumption, and people are starting to become a little bit more cautious. Revenue growth. I think a lot of companies will report good revenue growth numbers, but I think what's important is that how much of that is driven by inflation and how much of that is driven by volume growth. Hence, that breakdown between price and volume will be very important. And I think the companies that can show good volume growth, not just pricing, I think that'll be viewed more favorably by the market. Cost pressures. All of that will come down to supply chains. Shipping capacity has definitely improved and rates are coming down. And so that should help with flow through of costs for the industrials companies. But on the other hand, we've got higher electricity and higher labor costs as well. Raw materials, that's been volatile. So there's a few moving parts there to keep an eye on. Competitive environment. So from what I can see, the competitive environment has been quite rational over the past few years. Obviously, we've had a lot of supply chain issues, and getting hold of product and raw materials has been very difficult. And I think companies that have had inventory over the past few years have pretty much been able to charge whatever they like without worrying about losing market share. But now that supply chains have improved and customers do have more choice on where they can source product, I think customers or companies will be a bit more focused on pricing and competition going forward. Interest costs. Obviously, higher interest rates will have a flow-through effect on interest costs. This will affect most companies in some way, but especially the ones that do have higher debt levels. And across the industrials coverage universe, the companies that do have the highest gearing are Cedar Woods Properties, Amcor, and United Malts Group. But in general, the balance sheets across the sector are in reasonably good shape. M&A. I think M&A is quite an interesting one because during COVID, there were a lot of lockdowns and also travel restrictions. So it was quite hard for companies to actually get out on the ground and do some proper due diligence on a potential M&A opportunity. In addition, COVID was either a really big positive or a really big negative for a lot of companies. So I think it was really hard if you're looking for an acquisition, it was really hard to assess the true earnings potential of a business over the longer term. So I think in that regard, companies have been a bit reluctant to do a lot of M&A over the past few years. But with things back to normal, we think that M&A could be back on the cards, and the ones that could be potential active acquirers are Amcor, Elders, Johns Lyng Group, Aurora, Orica, New Farm, Probiotech, and Silk Logistics. On the other hand, Incitec Pivot, they'll be focused on the sale of Waggaman, and then the merger of its fertilizers and explosives business later in the year. While we think People Infrastructure or People In looks like it's up for sale and potentially looking for a bid from private equity. So overall, we do think that there could be a bit of a pickup in M&A activity this year. Construction activities, obviously construction is quite sensitive to movements in interest rates. In the residential housing market, activity is likely to remain subdued on the back of the sharp increase in interest rates that we've seen over the past 12 months. This will have relevance for companies such as Brickworks, Reliance, Reece, Mars Group, and Cedar Woods. On the other hand, if you look at the civil infrastructure market, that is still very strong. So companies that are exposed to that space, such as Mars and Acro, should continue to do well. FX. So we do have a lot of companies in our space that have operations in Australia, but also overseas. And whether they report in Aussie dollars or US dollars, a lower Aussie dollar is usually a tailwind for earnings. Obviously, a high Aussie dollar would have the opposite effect. And then finally, sustainability. So just given how important sustainability is these days, we do expect a lot of companies, especially the bigger ones, to make some sort of comment in relation to how they're tracking in relation to their towards their sustainability targets. Okay, so here are just some charts that just put together, I guess putting some of the key themes I just spoke about into a bit more perspective. The chart on the left is headline inflation in Australia, the UK, and the US, and you'll see that while inflation in Australia and the UK is still, I guess, tracking up towards the back end of December, you can see that with the green dotted line that US inflation is definitely coming off. The chart on the right shows ocean freight rates from the key route of China to the US. And you can see that after peaking at about $22,000 in mid to late 2021, it's come off significantly and was trading at about 2,700 in October last year. So I just checked rates a few days ago, and rates are currently at about $2,000. So shipping rates have definitely come down over 90% over the past 18 months. And obviously that will help ease some of the cost pressures. One of the other key factors is obviously the oil price. After peaking at around this time last year following the invasion of Ukraine, the oil price has gradually come down, which is good. And then also the Aussie dollar is important. And as I was saying earlier, we do have a lot of companies in the industrial space that do have operations or earnings impacted by the translation in the Aussie dollar. And then these charts just really give you a quick snapshot on the US housing market, and which does have relevance for Reliance, Reece, and also Brickworks. The chart on the left is existing home sales. And why that's important is that people generally renovate their homes before they sell it, and they also renovate their homes after they buy it. So it's a reasonably good indicator of future renovations activity. And then the chart on the right is US housing starts, and obviously that's an indicator of new construction activity. And you can see from both charts that activity has been weaker over the past 12 months on the back of the higher interest rates. Okay, so positive surprise candidates. So these are the companies that we think could positively surprise or at the upcoming results, including this list are Acro, Mars, and Silk Logistics. For Acro, FY22 was a really good year for the company, and they had 4 upgrades during the year. It's already off to a good start in FY23 with 1 upgrade already, and momentum is really positive for the business. So we do think that the result could beat expectations. On Mars Group, weather in the regions has been fairly dry in November and December. So we do think that that could see Mars exit the first half at a run rate that is towards the upper end of guidance. And just noticed that Mars has just put out a trading update, so I'm sure we'll hear more on Liam on Mars. And then Silk Logistics, so port volumes have been steady, but pricing has been very good, and occupancy rates within its warehouses are running at over 90%. So we do think Silk is well placed to report a strong first half result. Negative surprise candidates. So these are obviously the ones that we think could miss or provide a weak trading update. Including this list are Incitec Pivot, GrainCorp, and Cedar Woods. So while GrainCorp and Incitec Pivot won't be reporting this month, they will be reporting AGM trading updates on the 16th of February. So for Incitec, Gas prices in Europe and the US have been weak, and this is causing fertilizer prices to fall. Given that gas is a key input into fertilizer production, we think that if gas prices stay at this level or track lower, and if we get further appreciation in the Aussie dollar, then we do think that there's some downside risk to consensus forecasts. For GrainCorp, given its winter crop was lower than expected, and some of the exports are likely to be impacted by supply chain issues as well as the floods, we think that our FY23 forecast may be too high. And then Cedar Woods. So for FY24, our numbers are about 20% below consensus. So on the back of the weaker housing market, contract volumes will likely be weak in the first half, and that could flow through to weaker settlement guidance. Okay, and then finally, our key picks across the industrial space. So we like Acro, InvoCare, Ventia, Mars Group, Silk Logistics, and ProBiotech. So on Acro, as I said, we do think it is a potential positive surprise candidate, but over the longer term, we do think that leverage to growing activity in the civil infrastructure space will put the company in good stead. Despite the strong share price movement over the past few months, the stock is still only trading at about 7.5 times FY24 PE, with a yield of about 5%. So we still think there's potential more upside to go in that name. InvoCare, I think this is really interesting one because ironically, it was actually negatively impacted by COVID, really due to the restrictions and lockdowns that were in place over the past few years. People had better hygiene, there was social distancing, and international borders were closed. So, population growth was zero. All that had a negative impact on the number of deaths, as well as the number of people that can gather at funerals. But now that things have opened back up, the number of deaths have rebounded and are now tracking above historical averages. And with international borders open back up, that should see population growth pick up again. So I think the outlook is starting to look a lot better for InvoCare. And even if you take a step back, it is still a very good defensive business. Ventia, we think the stock's been weighed down by the downgrade in December and some company-specific things such as accounting irregularities. And we, the stock closed at about $2.46 yesterday, despite being a different business to Downer. But we think that once the sell down clears post results, and Ventia can show good growth and cash conversion, we think the stock can move towards that $3 mark over time. Silk Logistics, as I said earlier, we think Silk could report a strong first half result. The stock's only trading on an EV to EBITDA multiple of 4 times and remains a discount to peers. So we think the stock remains attractive. And then lastly, ProBiotech. So we think that the company will be a key beneficiary of over-the-counter and prescription pharma production onshoring, as well as increased demand for cold and flu products. And that should be a positive driver of the company's earnings longer term.